The final instalment of the course What Affects the Price of Gold by Orunam. We'll be discussing the role of central banks, the US dollar, and also gold's beta. The gold price is heavily influenced by the central banks because central banks for each country hold gold. Not every country, but most countries' central banks have massive gold positions, and the pure size of them means that when they buy or sell, it's in such big volume that it can move the gold price. But what's more perhaps important than this is that once the transaction has actually occurred, if that's made public, it's going to influence individual investors as well, because if a key central bank becomes a net buyer, it might make other people want to buy gold or increase their exposure to gold. And the converse is also likely to hold. If a key central bank begins to sell their gold, then other people might be spooked by that and want to reduce their gold holdings. But when we look back historically, in the 1950s and 1960s, most of the world was under a gold standard, and in this period, central banks were mainly buyers of gold. And then we had a 30-year bear market in the gold price, and central banks were pretty much net sellers. And this happened because there was better returns elsewhere. Gold was flat. It wasn't really doing anything other than drifting lower. And Gordon Brown, the Labour Prime Minister at the time in the UK, he was quite famous for selling right at the bottom of the market, and that's why it's called Brown's bottom. It took until 2010 for central banks to become net buyers. So overall in 2010, there was more buying than selling by central banks. And this was the first year since 1988 that central banks were net purchases. And you can see from this graph with data from the World Gold Council where the buying and selling was happening on aggregate for central banks and when. And you can see that there was a lot of selling in the 90s. And around the turn of the millennium, you saw that this selling started to pull back a little bit. There was a lot less selling by central banks. And then in 2010, central banks actually flipped to become net buyers. And then there was a lot of buying activity. In the decade between 2010 and 2020, there was a lot of strong buying from central banks, and a lot of this was from the East, Russian central bank and also the Asian central banks as well. If you look at official data, the Chinese central bank was a big buyer, but it doesn't really record data that well. So I think that a lot of the domestically produced gold in China was actually bought up by the Chinese central bank and didn't really make its way to official records. So I think that overall the central bank in China has a lot more gold than what they've declared. And as well, in 2018 the central banks purchased the most amount of gold since 1967, and this activity heavily influences the price of gold. Conventional market wisdom will say that the gold price and US dollar index is inversely related, so that if the US dollar strengthens, then by default the gold price will go down. And while this holds most of the time, it's not a hard and fast rule because there are exceptions which we'll get to on this presentation. But because gold is valued in US dollars, it means that if the value of the US dollar index increases, then it means that the US dollar has strengthened and it can buy more on the international market. So because the US dollars become stronger, it takes less of them to buy that same ounce of gold. And the converse will hold as well, because if the US dollar depreciates on the foreign exchanges, then it will take more of these weakened US dollars to buy the same ounce of gold. And this gives the sort of impression that gold prices are going up and down, when really all that's happening is that the US dollar index is fluctuating. And a good book for this is The Economics of Entrepreneurship. This will talk about how depreciation of currency influences prices. One of the key determinants of the price of gold is risk tolerance, because gold is seen as a safe haven, and it has safe haven properties because whenever there is a crisis or an event that has negative impacts on the global stock markets and other risk on assets, gold doesn't necessarily have to go up, but in general it does. I've seen quite a few times when there's been a bit of a bloodbath on the stock market and gold is flat. Gold holds its value very well when other assets are being hammered. And that's because it's a safe haven. And there's a book called The Golden Constant, which is quite famous amongst gold investors. And that claims that gold is the only asset that outperforms in periods of inflation and deflation. And as just mentioned, gold is a safe haven, so it can be a very effective diversifier for a portfolio. If you're a wealthy individual and you have a lot of exposure to the stock market, you might want an asset that's going to hold its value or even go up when your holdings in equities are going down. And the higher the beta for gold, the more of a demand it's going to have for a safe haven. And what I mean by beta is the difference in the movement between gold and the stock market. So if the stock market goes down and gold doesn't follow it, then there's a disparity between the two asset classes. They've got different things driving them. Whereas if gold went up when the stock market went up and gold fell when the stock market fell, there wouldn't be much of a beta. And so investors wouldn't really see the value in holding gold if it's just going to mirror and track gains or losses in their stock portfolios. So the more gold moves independently of other mainstream assets such as shares, the more demand it's going to see, and that is what is meant by gold's beta. And as already stated, gold is a safe haven asset. There's other safe haven assets out there such as the Swiss franc, the Japanese yen, but overall gold is the king of safe haven assets, and part of the reason for this is that gold is the only financial asset that has no third-party counterparty risk. And this means that there's no one that can default on a bond. A company can't go to zero because of fraud or that the company becomes insolvent. There's all third-party risks in assets like that. But with gold, a bar of gold is a bar of gold. It's an asset. There's no liability there. And this becomes very valuable when there's turmoil, when there's defaults going on, when banks are going under, when shares are collapsing. People want gold in those times. And also when the stock market is giving investors quite a moderate return, a steady return, and there's not much volatility, the market's just drifting up, the demand for gold could actually fall because everyone's quite comfortable with their risk. They're seeing that their shares are gradually going up week on week, so they're not really thinking about hedging that. And this is why that gold is a very good risk off asset. And when the market is in risk on mode, which means that people are more optimistic about the macroeconomic environment, gold can be sort of forgotten about until a crisis happens, and then there's a scramble for gold. And in the same vein, when discussing safe havens, the US dollar does function as a safe haven. It does have some safe haven properties. And the reason for this is that when there's a crisis or there's some sort of turmoil on the global markets, if you are a key or big emerging market trader or investor, you would want to sell your domestic currency because it's much more volatile. Smaller currencies are a lot more volatile than the US dollar. So you would want to seek sanctuary in the US dollar because it's the world reserve currency, but also the US economy is a rich nation. They're a lot less volatile than somewhere like Venezuela or Colombia. So if you were from there, it would be good for you to sell your home currency, buy the US dollar just while the turmoil was going on. And once the crisis is over, you can unwind that position. But this whole activity of demanding US dollars in risk off times, this means that gold and the US dollar can go up together and down together because of their safe haven properties.